In this week's video, we'll examine history to help us answer the question, is the stock market near a volatile inflection point? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These are the main bullet points that we'll be covering, including the rare sideways pattern in stocks over the last 2 years. We'll also touch on the continuous improvement process for the CCM market model. As we've been monitoring the model over the past few weeks, we've seen that the math is potentially near an important inflection point. What do we mean by that? We'll use some examples. These are weekly moving averages used by the CCM market model. There's nothing particularly magical about them, and they're not the only source of data that looks like we may be near an inflection point. We're using these weekly moving averages simply for illustrative purposes to show what the broader brushstroke of data is telling us. This is the weekly S&P 500 in 2007. Inflection points tend to occur when your moving averages and your math starts to get tight and somewhat indecisive from a multiple time frame perspective. Here, your moving averages are telling you different things. There's white space in between them. When they start to congregate, it's telling you that they're all coming together in somewhat of an indecisive manner. And here, look at this tight look. Look how tight the moving averages are and how close blue is to these moving averages before really bad things started to happen in 2008. How does the exact same chart look today, and what can we learn from it over the past few weeks? Should be noted here, our objective is not to say an inflection point leans either way. An inflection point can tell us that a big move is coming in a bullish direction or in a bearish direction, as it did here in late 2007 or early 2008. Here are the same moving averages as of December 11th. Notice how tight they're getting here, and notice how tight they were here before a big move. A week later, on December 18th, they have somewhat of a mathematical, ominous look. We really never get a look like this in 2008. All of them are together and they're extremely tight. Fast forward a week to Thursday, December 24th, and we see we have two periods close by with a very, very tight and indecisive look. Out of this ominous look, we got a 2.76% rebound over the 4 trading days. What can we learn from this type of look and this type of look from a historical perspective? These are the same weekly moving averages in 1988, and I can't emphasize enough these moving averages and the illustrations that we can see on these charts are emblematic of a much broader brushstroke of the data. We're using these to illustrate what the bigger picture looks like inside the model. You can see after the crash in 1987, this look here is somewhat similar to this look here. We get tight moving averages, blue drops below, a lot of white space. Tight moving averages, blue drops below, a lot of white space. And then we come up and get a consolidation look. We start to get tighter, very tight in here, extremely tight here, and then a little bit more of white space here, but somewhat of a bullish look. What happened next in this case? After the tight moving average look, stocks did extremely well. Remember, if we go back in history, this is somewhat of a rare look here. This looks somewhat similar in 1995. If you've watched our videos, you know 1994 was a sideways consolidation type market. A more difficult market was followed by an easier market with stronger and more discernible trends. Remember, the point of the exercise is not to say the more discernible trend will necessarily be bullish. In this case, it was. There's a reason why we always talk about maximum flexibility. From tight formations and an inflection type look, we can get bullish or bearish outcomes, as was the case following the tight formation in late 2000. In this case, the more difficult and trendless market was followed by an easier and more discernible trend, but in this case, it was down. The 2011 case, tight moving averages, blue drops below, we get a waterfall plunge with a lot of white space in between. Current year, tight moving averages, blue drops below, we have a lot of white space in between. In 2011, we get somewhat of a clustering look, similar to the present day. In this case, the more difficult consolidation period after the drop was followed by an easier and more discernible trend that was up into calendar year 2012. Tight look, big move. Consolidation with a tight look, big move. Tight look, big move. Somewhat of a consolidation look here. We can expect from a probability perspective that a big move could be coming. If you go back and look at the chart in 1987, 1988, nothing says we couldn't consolidate in a sideways pattern for a few more weeks before the big move comes. That's relatively rare, but not unprecedented. Typically, the big move comes soon after a look like this. We'll head into next week with an open mind about bullish and bearish outcomes. For clients, we want to talk a little bit about the market model in calendar year 2015 and where do we go from here. First, it is not surprising that the model has not added value in 2015. Every single model on the face of the earth has periods of underperformance and periods where you get drawdowns. That's not particularly surprising. However, that doesn't mean that we shouldn't look for ways to improve the model and that we shouldn't look at the model with a critical eye from time to time. 2015, now we can draw a point December 23rd all the way back to November 15th of 2013. That's 768 calendar days with a lot of volatility and no progress. Keep in mind, we showed in the video a few weeks ago that something like this has only happened one other time in the past 30 years, meaning it is not unprecedented, but it is rare. You don't want to build your model around an event that only occurs once every 30 years. Having said that, there is nothing on the face of the earth that was created by man that is perfect, and that would include the market model. Therefore, we are always looking for ways to improve. 2014, 2015, having designed the model has been performing as expected. What do we mean by that? The model cut risk here in September, October of 2014 as designed. This was one of the rare V bottoms. Typically, when you get a move like this, it isn't followed by a V bottom and a new high. Typically, when you see something like this, you correct for several weeks or even several months. This is not unprecedented, but it is rare, and the model scaled in and out as we would expect it to. Normally, when the model scales in at a low like this, the stock market goes on to make significant higher highs. Not always, but typically. So the model worked as designed here. Here, the model scaled away from risk as designed. Nothing surprising. Similar to this period here. Typically, when you get a waterfall plunge like this, you go on to make at least one more lower low. We never did that. It's extremely rare that you get a waterfall plunge in intraday That's the low for the correction, and then you move up from there. The model has properly scaled back in off of a low like this. We didn't get a move to higher highs yet. That's to be determined. Now, having said all that, we don't want to assume anything about the future. There are numerous questions that we could ask. What happens if this continues for another 2 years? We've been backtesting periods this year long before the August plunge. It makes sense to go back and look at periods that you haven't looked at before. That process is ongoing, and it's been going on all year. We have also been looking at tools in TradeStation and multi-charts in ways that we can expand the macros that we have in Excel to work with backtesting to speed some of that up, to perform some walk-forward analysis and optimization. Optimization is not a bad word. It can be very helpful. Over-optimization is what's known as curve fitting. Proper optimization can be very, very helpful in model building. The purpose of a continuous improvement process, especially when you're building models, is to double check and recheck the analysis that you've done in the past, and also to challenge the assumptions that you've made in the past. As you go through the continuous improvement process, you don't have any preconceived notion as to what you're going to find. It's just prudent to always question and double check. A fair question may be, Chris, how can you be confident after what was a very, very difficult calendar year 2015? Your stocks versus bonds going back over 2 years. This is incredibly indecisive. The market model is a conviction model. There's no conviction in this market. Why are we not panicking? Because periods like this are not that unusual. They happen, and they happen often when the Fed is changing interest rate policy. History tells us, fractals tell us, that the stock market or price behaves in the exact same manner on a 60-minute chart, daily chart, weekly chart, and monthly chart. And if you trade or know technical analysis, we know that when we see consolidation on a daily chart and a breakout, that we tend to get a big move either up or down. What applies to a daily chart applies to a weekly chart, a monthly chart, or a yearly chart. Consolidation period and a breakout is typically followed by a big move in either direction. In this case, after a long sideways consolidation period, the S&P 500 rallied for 13 years. What does a sideways period between 1926 and 1955 have to do with the present day? The S&P 500 recently moved sideways for 17 years. We had a breakout at 1600. Are we still above and holding the breakout? We are. And we know that typically when we get a sideways move for a long time and a bullish breakout, fractals in history tell us that when stocks move sideways for years, typically the more difficult period after a breakout is followed by an easier period with much more discernible trends. Remember, the point of this video is not to say the next move after a possible inflection point will be bullish. It absolutely, positively could be bearish. But keep in mind, in 1982, if you were around and you knew the economy and the markets, you would not have expected a move like this. In fact, Business Week ran the death of equities cover in August of 1979. So obviously there were reasons to be pessimistic, and yet gains followed the sideways period of consolidation and the bullish breakout. Remember, historically, after markets go sideways for long periods of time and you get a bullish breakout, good things tend to happen. And the bullish breakout after 17 years of consolidation is still intact. How does that help us? It simply tells us to keep an open mind about all outcomes. It's easy to understand and visualize bearish outcomes from chart patterns in 2015. It's also important to understand the longer-term picture, and that we're all human and we're influenced by recency bias. Recency bias tells us that we came up, made a peak in the year 2000, and then we dropped 50%. We came up, we made a peak in October of 2007, and then we dropped 50%. Now we've rallied and we're making a peak again, according to recency bias, and we're going to drop 50%. Could that happen? Sure, it could happen. But it doesn't mean that we can't consider bullish outcomes as well. Back to the present day as of December 24th, no resolution yet either way on the chart of the NASDAQ, the Dow, or the S&P 500 index, which stalled at a logical level on Thursday, December 24th, but it remains inside of this indecisive trading range that began in early November. Since we know a mathematical inflection point can have bullish or bearish outcomes, it's good to have guideposts. The fibs off of the low from point A to point B, 38.2, 50%, 61.8. Purpose of the exercise here, as long as we stay above these fibs, it's easier to keep an open mind about a bullish resolution. If we break into this area here, the longer we stay below it, the more steam the bearish case picks up. If we understand extremes like 2008, extremes like the bottom in 2009, we can better understand the present day. Regular viewers and clients can pause this if you want to examine it further. November 2011, things didn't look particularly good here from a probability perspective. This chart eventually morphed into this gain. In the present day, we're incredibly tight and indecisive. This is a zoomed in look as of Thursday, December 24th. You can see right here we have a full bore bullish look with blue on top, price above all the moving averages, and the slopes of all of them are up. But this tight look here tells us we're near that mathematical inflection point, and we could roll over as we did here when we had the tight moving averages, or even here earlier in calendar year 2015. Here's another example of a guidepost telling us we may be near an inflection point. S&P 500 .com bust peak 2000-2001. This is the 100-week moving average. In 2015, we are 7 months from when the S&P 500 peaked in May. Here is 7 months after the S&P 500 peaked in the year 2000. Notice we gave up the 100-week moving average, and then it rolled over and price stayed below it, and bad things happened. Similar situation in the .com peak. 7 months after the peak in October of 2007, we failed to recapture what was now a flat and rolling over 100-week moving average. In both cases, there's very little in terms of a fight by price near the 100-week moving average. If we look at the same 100-week moving average year-to-date as of December 24th in 2015, unlike these periods where we did not put up a real fight near the 100-day, we've recaptured the 100-day and now are sitting near it. This, too, is telling us we may be near an inflection point. How can that be? Well, notice in this case, when the 100-week mathematically was given up, really bad things started to happen after the .com bust peak. Similar situation in the financial crisis. We gave it up, we tried to recapture it, we failed, and after that, really bad things happened. If we move below it mathematically, it puts us on a path that gets closer and closer to these scenarios here. This is just one example like the other examples, that's emblematic of what the math is telling us. Therefore, this slope and price above is telling us to keep an open mind about better than expected outcomes. If we move down here and this starts to roll over, it tells us to keep an open mind about worse than expected outcomes. Price did not miss the really bad period in 2000, nor did the moving average. Price didn't miss it. The moving average flattened out and rolled over. If bad things are to happen in 2016, which they may, price will most likely give up this 100-day and eventually it will roll over. All of this is telling us to keep an open mind about all outcomes. The hard data, the trends, the charts, the risk-on, risk-off ratios will guide us over the next few weeks and months if we're willing to listen with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.